no FOMO, no leverage, self-custody, or custody in multiple places. Just do the right things. Don't just trade on any 100x coin. Have an allocation which is like 90% core, large crypto, 10% for degenning. Do anything you want in that, because then it'll all go to zero. You'll prove to yourself that you're actually shit at this game, and buy and holding works. But if you want to prove to yourself how shit you are, please have 10% to do that, and then laugh at your bag of shrapnel. I didn't do any selling this time around. I kept with what I did and then added, and it's worked phenomenally well. And then I did the asset switch from ETH to Solana. I probably wouldn't go. I don't know what I'm going to do yet. When you debase the currency, only things of value retain value. Fixed assets. And that is art, wine, crypto, equities, high-end real estate, these kind of things, the things that the rich people own, apart from crypto, because everybody can. It's the first democratized scarce asset, finally. Gold does well too. Well, it does worse than it should do, but that is what debasement does. It devalues it against valuable things. Unfortunately, as humans, we're not valuable. Our wages don't go up in line with monetization of debt. Debasement is happening at a pace of, on average, about 15% of the year in the United States, while wages rise more in line with GDP or just inflation itself. Nobody gets ahead. So what happens is asset prices go up and wages don't. Why do goods not go up? This is the confusion everybody has. It's printing money, it's inflation, it's asset price inflation. Goods inflation, well, these are variable inputs. You can make more of this stuff. Variable stuff is not as valuable. And variable stuff, therefore, doesn't get adjusted because you're not adjusting the demand in the economy. It's not actually people buying more things. Really, what it is just a monetary trick. So it doesn't move these variables because there's no extra demand. You're not booming the underlying economy. You're just changing the asset price versus its denominator. Now, when we go out towards 2030 and beyond, I don't even know what the world's going to look like anymore. I spent my whole life living in the future, and I do not know the disruption of AI, robots, genetics, abundant near free energy, all of the things that are coming. I think it just completely changes. It's a singularity event for economies as well as humanity. And I think it might change economies first. I don't know what businesses even survive, what new businesses are, what the business models are. I know nothing. And that's an honest answer. So I do know we've got 1 or 2 cycles left of the everything code, because we can't avoid the everything code because nobody can pay the debts, and in which case the whole system collapses, which they won't do because the baby boomers need to retire and they're trying to support the baby boomers savings complex and the government itself. They can't raise taxes to pay for the bills because they've got any money, and politics are too fragile right now to raise taxes. So they just clip the coins instead, which is debasement of currency. Technology stocks and crypto. And crypto is the fastest horse in the race. And now, why don't fuck this up is because neither of those 2 assets are particularly easy to own because they're volatile. They want and people hate them. You shouldn't do this. You shouldn't do this. Buy my value investing stock. You should buy the Russell 2000. You should diversify, my friend. And meanwhile, we've got probably 2 cycles less. 2 cycles less left to not fuck this up. Generally, on a macro secular theme, I'm usually not wrong. The paths, they can change. So anyway, so don't fuck this up is important. It's trying to teach you how not to get shaken out. There will be a down cycle in the middle. You need to understand how that's going to work. And then finally, really at the end of it, we should have unfucked our futures. If you're young or if you're old, you've got a real problem on your hands. I can see that by the retirement crisis video got viewed 4 million times online because it's a stress point for people. If you're young, it's like, God, I've got student debts. I'm 35 years old. I've got student debts. I've got 2 kids now. I've got married. I've had to move out of New York City or whatever city. I'm worried about job security. How's everything going to change? How am I going to save? I'm putting money in my 401k. Doesn't seem to pay for a house. How am I ever going to pay for a house? These are the answers. This is why the millennial population are drawn to crypto hugely, and rightly so, because they want and need that risk to give them a chance to do what their parents had. And that's why they're drawn to technology investing and even in option investing. If you're doing that if you're doing standard investing in your 401k and with your discretionary side, you're trying to get ahead by taking these wilder bets, I think that's a pretty sensible investment strategy. I have no issue with that whatsoever. All of this commercial real estate being shoved off their balance sheet onto the Fed balance sheet, which will be part of the QE or whatever they call it this time around. They'll find a different terminology to stuff onto their balance sheet to pay the interest on the debts so they can roll the debt, because there's far too much debt, and that all has to come in 2024, 2025, which is why the whole stimulus machine starts coming. Lovely world we live in. That's all part of the everything code thesis and the exponential age. What else are we looking at? There's not a lot going on, oil markets up and down without the economy yet coming through the other side. It's not going to do anything. Same with copper, can't get out of its own way. Same with cyclical stocks, won't get out of their own way for a bit. Dollar should weaken over time. That should then eventually cause a bid to emerging markets and others. The only secular bull market in dollar terms of pretty much all of the major emerging markets is India, which I bleated endlessly on about. But India underperforms the NASDAQ. NASDAQ underperforms crypto. I choose to ride the fastest horse. If everything's fucking correlated, then what's the point of having a diverse portfolio? That's not for everybody. That's just how I see things. I still think Tesla is the stock for 2024. I admit it trades like shit right now. Again, we have to ignore all of the noise around Elon Musk. This company sells more EV cars, is further in self-driving, further in robotics, and further in AI than any company in the world, particularly that nexus. So they best represent the exponential age. So anything about Musk, I think, is a sideshow. It may hurt the stock. Really, what's going on with the stock? Tesla is 2 companies. One is a technology company, and that is why it did very well last year from the lows, because it's following all the other tech stocks. It's forward-looking based on the forward-looking economy. However, right now, the current economy, where ISM is today, is low. That's when car companies build up inventories and people don't sell enough stuff. Now, if I'm right about 2024, then we'll see the ISM pick up, and then we'll have more car sales, lower inventories, and a technology story. And that's why I think that double whammy makes it a very attractive play. So I'm not sure, Tad, if there's any issue here with Musk overall. We will see. There are 76 million baby boomers in the United States alone. They are all retiring. They are all holders of equity, not bonds. In Europe, they're bond holders. So they're basically safe. And Europe's got a welfare state, but it means that government spending in Europe goes up to pay for it. In the US, there's less of a welfare state, and most of these people have been in equities. Now, what you can't have is a retired population living off their savings and the equity market halving, because then you've halved the wealth of the most wealthy cohort in the world. The damage it will do to your economy, it will never recover from. That is why Janet came in and stepped in with her liquidity when the S&P was down 25% last year.